Are you contemplating an investment but torn between active trading and passive investing? Comprehending the distinction is vital for your financial achievements. Active trading and passive investing represent two unique strategies in the markets, each with distinct risks and levels of commitment. Active trading focuses primarily on short-term profits. Traders frequently buy and sell assets, seeking returns from market movements within minutes or days. This strategy demands intense dedication to technical analysis and constant market scrutiny. Due to its high-risk nature, it requires unwavering discipline and a precise execution of trades. Conversely, passive investing adopts a long-term perspective. Investors purchase and retain assets for extended periods, capitalizing on the economy's growth. This strategy is low maintenance and emphasizes fundamental asset analysis, involving minimal daily engagement. Given its lower risk exposure, it enables investors to manage market fluctuations more effectively. A significant challenge for novices is the potential mismatch in commitment levels. Many try active trading while thinking like passive investors, often resulting in notable losses. If daily analysis and strict risk management seem impractical, passive investing may be your preferable route. Before engaging in trading, it's crucial to assess your available time and risk tolerance. Making informed choices is essential. Matching your trading strategy to your commitment level is pivotal for safety in the financial markets. In conclusion, active trading and passive investing fulfill different objectives. One pursues short-term gains with elevated risk, while the other seeks long-term growth with decreased risk. Carefully evaluate your daily commitment capabilities to ensure you select the most suitable method for your financial journey. Ready to move forward? Determine your investment style today.